All right. Testing. Looks like our sound is working. Welcome, everybody, to CryptoNITE episode 2. I'm here with Rhett Ship again. We're going to be here with Rhett Ship every time, so I said that like it's not a common thing, but it's Rhett and I, all right? And I guess in CryptoNITE chat, I can be known as Phil.
Yeah.
Is that fair?
Yep.
That's fair. How's everyone doing tonight? We've got my wife tuning in. I want computers to make all my money for me, please.
And glad to have you, Brenton. I like Zerg in your name. It's awesome.
Is that a StarCraft name?
Yeah. I mean, that's the only Zerg I know. I guess there's the Emperor Zerg in. Isn't that a Toy Story or something?
Yeah.
It's gotta be a StarCraft.
That was a random 90s fact right there.
Both. Oh, nice. Yeah.
Perfect.
I'm more of a StarCraft, more StarCraft aware than.
That's true.
That was my first gaming love.
So thanks everybody for migrating over here. We started this channel simply because we didn't want to bombard people who are only interested in gaming with crypto notifications and didn't want to bombard people who are only interested in crypto with gaming notifications. So here we are. Theo keeps yelling daddy to the TV. Hi, Tezio. Thanks for supporting our early CryptoNITE streams, son. Thanks for migrating over. Hopefully there will be a Discord notification. Oh, it worked. Look at that. All right. We've given some time for everybody to join in. Today, our topic is, if you didn't look at the title yet, it is decentralized borrowing and lending. Chipsky is asking it Zerg or Protoss, Red. This is an important question, I think.
That's a good question. Back when I played more, I always played random, actually. I feel like I played worse if I chose my race. I don't know why. So Zerg, Protoss, and Terran. Terran's my worst, though. So I don't know. One of those two. Terran's hard. Zerg all the way.
Perfect.
Nice.
Hey, I'm glad my son likes me when I'm, live streaming.
Yeah.
We just got to work on the real life part. So, like I said, we're talking about decentralized borrowing and lending. We've got some new people in the chat, I think. So I think we might review some of our topics from last time just quickly. What do you think about that?
Yeah, that would be great.
Perfect. So last time we really went over what is decentralized finance, what is a decentralized exchange, and we also talked about Bitcoin, right?
And Ethereum, yep. Smart contracts, blockchains.
Yes. So Bitcoin, I'll just start with Bitcoin, as a lot of us know, is the first legitimate cryptocurrency, and really pioneered the use of blockchain in order to solve the double spend problem, right? Red educated us about that last time. It's if you create a digital token and you spend it somewhere, how do you know that you didn't spend it somewhere else? And the blockchain, which is a ledger that tracks all of the transactions that ever happened, solve that problem because we know exactly where this Bitcoin went. Next, I'll let Rhett chat a little bit about what decentralized finance means, and then we'll move on to DEXs.
Yeah. So decentralized finance mostly built on Ethereum. Ethereum built on the Bitcoin blockchain and added smart contracts that allows you to write programs, write code associated with the blockchain. And that empowered a whole bunch of applications. Decentralized finance only being one of them. There's this whole NFT thing. We'll actually have an episode about that, maybe multiple episodes about that in the future.
Definitely.
And there's a lot of other things you can do. But yeah, decentralized finance is a way of doing the things you do in finance, borrowing, lending, exchanging assets, etc., without centralized intermediaries like banks.
So without a Chase Bank or without a Fidelity, right?
Yep.
And hopefully one day without mortgage lenders, right?
Yeah.
We had some interest about that last episode. So,
yeah.
Perfect. And a decentralized exchange is one of these decentralized institutions. It's like a Fidelity where you can exchange assets or borrow and lend without the Fidelity, right? It's you are the agent in the transaction. You're interacting directly with other crypto investors or crypto holders. and it's recreating the market dynamic.
Yeah, there's some huge benefits to that, and we'll actually have probably a whole episode about decentralized exchanges as well, and get like into a deeper dive into what they are, what the value proposition is there. There's several reasons why it is better than centralized exchanges. Well, I view it as better, but there's a lot of advantages it has over centralized exchanges.
Right.
But we'll talk about that another time too. And then we have this big other area of decentralized borrowing and lending. Much of decentralized borrowing comes from decentralized lending. Just like in a bank, if you're borrowing from someone, if you're borrowing,
is lending to you.
Yeah. But there's another kind of decentralized borrowing that doesn't involve a lender directly. So we'll talk about both kinds, and what kind of yields you can get on things, etc.
Excellent. Perfect. So our agenda for today, kind of what we're planning on talking about, is decentralized lending and borrowing for 15 to 30 minutes, and then we'll pivot over to Q&A. And the questions don't necessarily need to be related to decentralized lending and borrowing, but we'd love to explore a variety of topics each episode. So no questions too simple. You don't need to worry if you're brand new to crypto, don't know anything about it. Basic questions are totally fine and welcome. And also during this first part where I'll talk a little bit about lending and borrowing, feel free to interact there too and ask questions about that aspect. And I'll try to be responsive to those things. And then, we can have a more generalized Q&A after. Perfect. That's what I like. So to start us off on decentralized borrowing and lending, there's a topic that you briefly touched on that I think I'll bring up again, right? Not all decentralized borrowing is decentralized lending and vice versa, right? Or did I get that wrong?
All decentralized lending involves borrowing. You don't lend into, you don't lend into a vacuum. So all decentralized lending has a borrower on the other side, but not all borrowing has a lender on the other side.
Okay.
Which is a strange thing to think about if you're not familiar with the space. So I'll talk a little bit about how that kind of comes to exist.
Awesome. Great. So you want to start with borrowing or lending?
Yeah, let's talk about the base case of where you have a lender and a borrower. I'm going to talk a little bit about what some of the general DeFi tools are, where that's done, and then what those funds are being borrowed for, and then also what kind of yields you can get. So
yeah, I want to reinforce that point, right? The why about why we're talking about this is there are yields to be had, right? It's a lucrative pursuit as a crypto investor to get involved in these activities. And that's the reason that we want to bring it more into the mainstream, right?
Yes.
With CryptoNITE. So
that's like a basic way of, you could say, like leveling up in crypto is like, okay, step one, maybe buy a little Bitcoin and Ethereum. Step two, take the Bitcoin and Ethereum and lend it.
Yep.
And there's even like a second group of people who are like, I'm skeptical about the value of Bitcoin or Ethereum. You can lend dollars too and just get better yields than you can get in traditional markets as well if you're a crypto skeptic. So this is how you're rich. Yeah, it's part of it.
This is one avenue that's worth learning about at the very minimum.
Yeah.
Stripe Tech.
Yeah. So kind of one of my views is like, if you're going to hold Ethereum, you might as well lend Ethereum and get some yield on it, as long as you're doing it in a safe place. And we talked a little bit about that in the past. Some decentralized protocols are more secure than others. I'll talk just about some of the ones that are very secure, that are heavily used and have long track records, etc. Yeah, it's a good point, Matt. So, and actually, we can talk about that maybe in a second too. So just to start off, a couple of the main platforms where lenders meet borrowers are Aave.
That's spelled Aave.
Yeah.
Right?
Yep. That's a big one, Aave. And they're one of the earliest ones. Compound, spelled how you would think.
Mm-hmm. Nothing weird about that one.
Yep. Cream is another one, also spelled how you would think. And then the fourth one is Alpha Homora. And specifically, it's Alpha Homora version 2, where a lot of this is taking place.
Now, you mentioned the word protocols, right?
Yeah.
That means that these are smart contracts.
Yeah.
Excellent. Just wanted to throw that out there. The word protocol can usually be interchanged with smart contracts, and it means that it's code that was written to execute a certain task,
Yep.
right? In this case, to execute the lending transaction.
Yep, the lending and borrowing. Yep. Yeah, so you can go into Aave as a lender and you can say, hey, I have this asset. There's a list of supported assets, Ethereum, something called wrapped Bitcoin. So Bitcoin doesn't exist on Ethereum, but there's people who have bridged it in. People who own Bitcoin that want to do decentralized finance things will get a thing called wrapped Bitcoin. I can get into that another time, but you can do stuff with Bitcoin there. You can do stuff with stable coins. These are dollar peg tokens, and then lots of other tokens. So like one of the biggest decentralized exchanges is called Uniswap, and they have a Uni token. So you could, if you own Uni tokens, you can go lend them on Aave. Aave and Compound both support many different tokens. You won't find every single token on there. If there's some kind of like really obscure new project, it may not be supported yet. So there's and you know what's supported is increasing all the time, but there's there's a little bit of gatekeeping there because you don't want to necessarily support lending and borrowing for an asset that doesn't have some level of establishment.
Right. So the protocols do some level of filtering or vetting for tokens that have no substance or are known to be scam coins or something like that.
Yep, exactly.
Okay,
yep.
Excellent.
So obviously on the other side of the lending are borrowers, and most borrowers these days are borrowing for investment purposes. So it's similar to what people do, like take margin accounts in Robinhood for, you know, I'm in Robinhood, I have $100,000 of stock, I get a margin account, I can borrow using that stock as collateral, and I can buy more stock, so that now I have a leveraged equities position. That's kind of traditional finance. Here, that's the main way it's being used now. So like, hey, I think Ethereum's going to go up, I can buy Ethereum. Or if I want to be a little bit more risky about it, but increase my upside, I can buy Ethereum, use that as collateral to borrow more Ethereum from someone who's lending to me. So you could say the low risk way of amplifying your Ethereum returns is to lend it to someone who wants to borrow it and take a leverage position.
Right.
And then the higher risk side is to be on the lending side and say, hey, I'm going to borrow this Ethereum from someone else. And then
I'm going to lend mine and borrow more and increase my exposure. Is that what you?
Well, you would either be a lender or you'd say I'll take mine and use it as collateral to borrow. Because when I take the borrowing side of these, I can't just borrow with no collateral. Right. They need a way of knowing that I'm not going to run away with their money, and so these are collateralized loans, just like it is on Robinhood. I can't get a $100,000 line of credit on Robinhood to buy stock if I have an account balance of 0 in Robinhood, right? So similarly, some of these applications are more generalized though. So it's typically used by investors. In Robinhood, you have to use it to within their thing. I can't take a margin account, at least that I know of. You can't take a margin account and then pull that out and use that to go buy a car or go on a trip to Mexico and then say, well, I'm gonna pay it back and here's my collateral. So in Robinhood, it's application specific. In DeFi, there's some that's application specific and some that is more generalized. So while most people are doing it to take a leveraged position, most of the borrowers are, and that's in finance. That's an important function to support. What you could do is you could say, hey, I have a bunch of Ethereum. I'll use that as collateral to borrow this thing, and then I'll go use that to buy something, go buy a house with it or something, and then say, well, I'll be paying that back instead of paying my mortgage. That will be my mortgage.
Right.
And then as I pay that back, I get my collateral back. So that's most common. And generally you need, most of these are over collateralized. We talked about that last episode as well.
Yeah.
There is one of these, Alpha Homura, that has some that's not over collateralized, which at first would sound scary, but the way that it works, relating this back to the real world, is very similar to Zerd Crypto, Brenton. It's much like taking margin, yeah. So the way you can safely allow someone to say use $1 of collateral to borrow $7 on Alpha Homura is by doing something that has a close corollary to home lending in the traditional world. So part of the reason why a bank is willing to lend you $500,000 when you only have $100,000 is because the home itself is part of the collateral.
Right.
It's like, okay, you put some money down, that's good. But also, if you default, we get the home, and that's why it's important to them to appraise the home and make sure that it's worth that money. Otherwise, they won't lend it because the home itself is collateral. So in Alpha Homura, the way that they do that is they say, okay, when you borrow here, it is application specific. Just like if you get a home loan, you can't go spend that anywhere because they need to know you bought the home, and then there's collateral. That's part of your collateral. In Alpha Homura, and we'll get into what this is, you're lending to people who are taking that and creating what's called a leveraged yield farm. So they'll put up $1 of collateral and borrow 7, and then they have a leveraged yield farm, but that yield farm stays within the system. And if they fell below a certain level of, say they used $1 to borrow 7, and so they have a total value of 8, and they're earning yield there, and so the value of the position is actually growing over time. But if there was some adverse effect and it came down, and say it got to like 7.5, then they could get liquidated, and then you'd get your 7 back. So you don't have the risk of losing it. And so that yield farm that it was put into is itself collateralizing the position. So just like your home itself is partly collateralizing, is much of the collateral of the loan that you're getting in a mortgage.
So is it safe to say that if your position is decreasing in value, that the risk of liquidation is also part of the safeguard there?
Yeah.
It's part of the reason that you're able to borrow 7 with just 1. Right?
Yeah. It safeguards the lender. Exactly. And actually, we'll have a whole additional talk about what yield farming is and why leverage might be good or bad. And I think there's times when it's good and times when it's bad.
Right.
Another time. But from the borrower perspective, or from the lender perspective, you can deposit money in there. They borrow that, and you can get pretty good yields. So I personally participate in some of these protocols, and I own some of the protocol tokens. Each of them has a protocol token. So Aave has an Aave token, Compound has the Comp token, and Alpha Homura has the Alpha token, etc.
One way to conceptualize the tokens is to think of them as, in essence, stocks for those protocols. Is that correct?
Yeah. That's actually something I was thinking about earlier today. I think one of the most confusing things about cryptocurrency is the fact that it's called cryptocurrency, because most crypto assets are not, nor will they ever try to be currency. Just like you wouldn't call Apple stock like Apple currency,
right?
And then you're like, wait, do I buy stuff in Apple Store with it? And you're like, no, you own some of Apple. So if you own the Aave token, as Aave gets used more and more, and they create these lending interest rates, so a lot of the lending yield goes to whoever's lending, but a small portion of it goes to the protocol, and then that will accrue back to token holders. Yeah,
almost like a dividend.
Yeah, exactly. Yeah, so you say, oh, this thing's getting a lot of lending, and that's creating revenue for the protocol, so maybe I want to own the protocol token.
Interesting. There's an interesting question here from Chipsky that's been up for a bit. That touches back on that. How much do they let you leverage? I feel like you sort of answered that by pointing out a 1-to-7 ratio. Is that how much Alpha Homura lets you leverage, or how does it work?
Yeah, so that's a great question, Chipsky. Thanks. So that depends on the protocol and the token. So when I was saying the 1-to-7, so within Alpha Homura, there are some tokens, specifically some of the stable coins like DAI, USDC, etc. We talked last time about these, but stable coins are dollar-pegged tokens.
So one of these stable coins should always basically equal exactly the value of $1.
Yeah.
Right? That is what a stable coin means.
Yep, it stays stable at the dollar. So stable coin lending or stable coin borrowing on Alpha Homura, you can get, I think 1-to-7 is the max. You can, so it's like 7x leverage.
So if you had 10 ETH, you could borrow 70 for a total of 80. Just to use Chipsky's numbers.
No, because he's wanting to borrow ETH. So, and so if he had 10 USDC, one of the stable coins, then he could borrow 70.
Got it.
But with ETH,
So that highest leverage ratio only applies to the stablecoins, is what you're saying.
on Alpha Homora, yes, and Alpha Homora, I think, is the only one that currently of the ones I named that allows that level of leverage. So, and it's because it's application specific, like I mentioned. But Aave and Compound, their max leverage ratios will be less than that. With ETH specifically, probably the most you could ever borrow is about, for 10 ETH, you could borrow another 10.
So 1-to-1.
Yeah, so that would be like a 2x leverage. And
That's still potentially very powerful.
There
right?
may be some that allow you to go a little beyond that, but I haven't seen it really get much beyond that for ETH specifically. And these protocols are pretty carefully planned as to like, okay, if we allowed someone to take this level of leverage, how much risk in the system is there, et cetera.
Right.
And I think a lot of the protocols will actually let you borrow more if you leave it in the protocol than if you don't. And there's some reasons for that, because that becomes part of the collateral, right? So so that kind of covers that aspect of lending and borrowing, which is like, that's kind of half of decentralized lending and borrowing, are just, hey, I have Ethereum, you want to borrow Ethereum,
you can borrow my Ethereum,
yep,
and I'll have a yield associated with that.
Yep, and we can kind of connect up in there. Now, one point to make about these, some people may be familiar with like the Lending Club, which is that's a traditional company that's been around for a while, where it was like this kind of peer-to-peer thing where I could be a and I don't know if they still even do it this way, but at the time they're like, hey, you could be a lender to this specific person. Mm-hmm. And I could go like, you want to buy a laptop or something, and I could lend to you and you'd pay me this interest or whatever. In these protocols, it's you're lending into a pool or borrowing out of the pool. So I'm not linked up to you on an individual basis. I lend into the whole Aave pool, and then they're like, hey, there's 1,000 ETH here. And then people can borrow out of the pool. Yeah. So that's like just a slight distinction between what you could do if you were like kind of connecting people individually up together.
Yeah. And actually, one point I wanted to make, talking about the real world is before we started today, we were chatting a little bit about how difficult it is to become a lender in traditional finance, right? Without a platform existing like Lending Club, it's very difficult for me to say, hey, I have $10. Who wants to borrow $10?
Yeah.
And I'll charge you interest for it, right?
Yeah.
But in the crypto world, in DeFi, that's very simple. Yeah. It's as simple as purchase some cryptocurrency like Ether or Bitcoin, get to the token that you want, and then lend it.
Yeah.
It's remarkably simple, and because the centralized institutions don't exist, there's no barriers to entry. There's no competition in the sense that people will try to prevent you from lending. There is competition in the sense that others are willing to support lower fee or accept lower fees, right?
Yeah, other lenders, or there's other protocols that arise.
Exactly, but there's no barriers to becoming a lender in DeFi, and I find that to be kind of shocking, right? Having grown up, I'm 30 years old. The thought of becoming a lender is just something that's like, well, I'm never going to become a lender unless I have millions and millions of dollars, right? So it's pretty cool.
Yeah. Well, there's some things that have smoothed that, right? So if you open up a bank account, which takes some time, but once you have one, then by having a bank account, you're lending, but you're getting a very low return. And we talked about some of the reasons for that before, and I mean, we're all aware. Yeah. And then if you have a brokerage account, you buy a bond from Apple, then you're lending to Apple, and you get a tiny little bit of interest, but there's there's work to get there, and then there's been a lot of work on the back end to smooth that. But because there's centralized parties in between, there's a lot of the return you would get as a lender kind of siphoned off.
Yep. That's my exact point there.
Yeah.
It's remarkably simple. That's right, Hugh Jackman.
Yeah, I hope. Yeah. So by the way, if there are things that we're talking about that don't make much sense, and clarifying questions would be great. We're trying to be simple about this stuff, but obviously not always meeting that goal.
It's our goal to start at the high level, but it very quickly gets more technical to understand the structure of DeFi, right?
Yeah.
I've seen some Discord messages by Rhett that read like investment banking analyst reports, and they are very technical, and there's a lot of underlying understanding required even to understand the topic being discussed, right? So it can get very complicated. So that's why we're continually saying no question is too simple, right? If there's something that's holding up your understanding, please ask it in the chat. We can clarify that point, and as a whole, right? Obviously, I don't have the level of understanding of DeFi that Red has, and I'm trying to move that direction, right? So wherever you're at, ask the questions that you need help with, and we'll do our best to take it to the next level.
Yeah.
Right? That's really what
Yeah.
CryptoNITE is all about. It's intended to be a chill evening where people discuss crypto topics, DeFi topics.
Yeah.
Rhett is wearing a collared shirt. I'm not going to lie. I haven't worn a collared shirt in a very long time. And I'm not about to start for CryptoNITE because, we're trying to have a chill night talking about crypto.
That was a big mistake. I won't do it next time. So I literally just like put on the first shirt that I saw. So that's how my wardrobe is always chosen.
Since we've moved to our new house, the first shirt that I haven't seen a collared shirt is the problem. So there isn't really an option yet. So
yeah,
we're getting some activity in the chat here. Maybe we should talk to it.
Yeah, so let's hit a couple of these questions, and then I want to explain the other aspect of decentralized borrowing that doesn't include a lender, which is interesting. So Matt Horn, great question about how long before people will be making large purchases with large DeFi pools. So there's a little bit of that happening now. I personally know at least one person who has made a real world purchase with one of these protocols. Take a decentralized loan and then use that to make a real world purchase. And I know I was listening to a podcast. There's some companies working on like explicit decentralized mortgage
Which is going to be very interesting.
protocols. Yeah. The big thing there is like just like a bank uses your home as part of the collateral, that you need to be able to get some of that info there and say, hey, okay, here's what the home is worth. And anyway, I won't get into all the things, but there's some known problems with like there's kind of like there are solutions that known ways to attack those solutions. So with homes, someone who has a ton of crypto collateral right now could do it now. Some probably have. With these decentralized mortgage protocols coming over the next several years, I think it'll become a lot more common over time. So yeah, I think it's happening to some extent now, but it's far less than 1% of all decentralized lending and borrowing. Like 99% of it is investment related. Not much of it is real world yet, which to me that just indicates how early we are in the space, like how much bigger this will become.
That was exactly the point I was going to make, right? These things are in the works, they don't exist yet. So that suggests that we're very early on in the process. Decentralized finance has a lot of maturing left to do. So the fact that you are here learning about crypto and DeFi puts you way ahead of the curve, right?
Yeah.
So awesome question.
Yeah. And
moving
Huguenot, really appreciate the kind words. We're trying our best, but hopefully we'll get better over time.
Huguenot and I had dinner together today.
Oh, Huguenot!
And so I mentioned to him that we're doing the crypto stream.
So Zerd crypto staking is different, and when we get to general QA, I'm going to return to this. That'll maybe be the first question we answer about staking. There's a few different things that are meant by staking, and I'll talk through what those are, but they generally are not relating to lending and borrowing. So good question there.
I'd like to address Hugh Jackman's question. I feel like people are just going to find a way to make all of this the exact same system as paper money, but with imaginary computer money. Like if there's lending and borrowing now, how long until there's just banks and then interest, etc.? It's a good question. We are trying, not we, I guess, I'm not explicitly trying to recreate traditional finance inside of DeFi, but a lot of traditional finance is intended to be recreated inside of DeFi. The key difference there is that smart contracts can replace institutions. So one of the things you're never going to see in DeFi is the bank, right? One of the key kind of foundational assumptions about cryptocurrency just in general is that you are your own bank. That's why there's no FDIC insurance for your Bitcoin wallet, right? If you lose your passphrase or your mnemonic phrase, you lose your money. Like there is no bank, there is no institution that's going to have your back. You become that institution, and the smart contracts replaces all of the functionality that traditional banks provided. So in my view, latent DeFi is going to look a lot like the traditional financial system, but without the banks. And and that's what's beautiful about it. We're going to be able to accomplish a lot of what we can accomplish today with traditional banking without that institution that, like Rhett said, siphons a lot of the returns that we would ordinarily make, right? So it's intended to mirror, but with some key foundational differences is how I would.
Yeah,
I would put it.
I think that's a really good way to put it. And I think there's the possibility that we end up with a mixed future system where, you know, you have a lot of people being their own bank, which is kind of what DeFi is to some extent, and then maybe you have other people that are still using a bank, but if you have a bank that comes and they say, hey, we're going to replace all of the systems that underlie our bank, replace them with DeFi, and then we're kind of a light wrapper on top of DeFi, and that efficiency we gain, we can turn around and offer our depositors higher yield bank accounts than we otherwise could. And so you could see that's a way that JP Morgan and Wells Fargo tries to adapt to and use DeFi to become more efficient. I think we're likely to see both to some extent. So yeah, we'll see how it goes. But I think there's a lot of incubation that'll happen probably before we get to JP Morgan adopting DeFi under the hood.
Yeah.
So
that's a topic for an entire topic for another day, right?
Yeah,
the possibility that actual traditional finance institutions will adopt the back-end structure of DeFi rather than what they're using now.
Yeah.
Which is kind of crazy to think about, but
yeah, and I think
also
that's
cool.
Yeah. I think that's down the line for sure. It's not like next year Wells Fargo is going to be all DeFi behind the scenes.
Right. But let's move on to borrowing without a
lender.
I'm interested in that. That isn't a topic I feel like I know much about. So
yeah, so one of the basic early decentralized finance protocols that did this is called MakerDAO. And what I found is if you can understand the basics of how MakerDAO works, then it makes it easier to understand all the other DeFi protocols. And we talked about it a little bit last time, but the idea is that MakerDAO uses a synthetic asset called a stablecoin as the thing that you're borrowing. So now, so in Aave, I say, okay, I have $1,000 of Ethereum. I come and I use that as collateral to borrow some more Ethereum, or I use that as collateral to borrow some dollars, stable coins, or whatever token I want. Well, in MakerDAO, you use your $1,000 of Ethereum. Instead of borrowing from another peer, you mint some DAI. That's their stable coin. So you say I have $1,000 of collateral, and I use that to mint $500 of DAI.
Mint meaning literally create?
Yeah, you're literally creating this stable coin. And the idea here at a high level, and there's some more complexity behind the scenes, but it's best to understand the general concept, I think. And then, if you're a real nerd like me, you can get into some more details, but the general concept here is that having excess collateral is a key thing that has kept the DAI stable at the dollar. So you say, hey, why am I going to value this DAI at $1? And one of the things that has helped keep it stable at the dollar is the knowledge that for every dollar, there's more than $1 of collateral underneath. And then they maintain that over collateralization also through liquidation mechanisms, where if I have $1,000, I borrow 500, I get my collateral back when I pay that DAI back with interest. But if before that happens, the value of Ethereum falls, and it's like, oh, you're getting, now your $1,000 of Ethereum is only worth $700, then you could get liquidated. And when you get liquidated, someone just basically exits you out of that position. They pay your DAI back for you, and so
receive a return for doing so.
Yeah, exactly. Now there's some details there. And so, and different systems do it slightly differently, but you're recapitalizing them. So you're making sure that you're preventing anyone from ever going underwater. So MakerDAO kind of pioneered this. That's how the DAI came into existence. It was the first decentralized stablecoin. There's centralized stablecoins, USDC, USDT. So USDC is just like a company that has $1 in a bank account for every USDC that they mint, and then they put that out in the world, and then they're like, hey, you could redeem that for $1 if you want to. So it's one-to-one backed with dollars. So you call that a centralized stablecoin.
It sounds suspiciously like the gold standard, where you could take your dollar bills and get gold for your dollar bills, right? Except it's
but the government ended up removing
dollars and electronic money, right?
Yeah, dollars and electronic dollars.
So to back up, right, we're using a lot of words. One thing that I struggle with when thinking about DeFi is there's a lot of proper nouns that people aren't familiar with, right? So MakerDAO is the protocol, right? And the stable coin that you mint by interacting with that protocol is DAI.
Yeah, in that case, yes.
Perfect. And so DAI, again, is a stable coin pegged to the value of $1. Mm-hmm. And to follow it along the chain, if I use $1,000 to mint $500 worth of DAI, but my $1,000 collateral drops to a certain point, I can be liquidated and be forced to exit that position.
Yes.
So just to step back and touch on all the main points in a straight line.
Yep. And we touched on this before, but that liquidation is much like, for any of you that are familiar with margin accounts in traditional finance, it's much like being margin called. Where, hey, I'm on Robinhood, I used $100,000 of Apple stock to borrow, X amount of money, and then my Apple stock fell on value, and then Robinhood forces me to sell some of my Apple stock to pay back loans, so I don't risk going underwater. So it's a very similar concept, probably helpful to those familiar with margin accounts, but maybe not those who aren't. Let's just see, Mandelaine, could you use crypto to pay off your debt?
Or to your point earlier, would you need collateral to do so? Like I already have a lot of Bitcoin or Ether.
Okay, so yeah, let's clarify this question a little bit, Mandelaine, if you don't mind. So when you say, could you use crypto to pay off the debt that you incurred in the MakerDAO system, or are you talking about use it to pay off real world debt?
Yeah, I think that's a good clarification.
So I'm assuming you mean, could you use crypto to pay off the debt in the MakerDAO system? If you wanted to pay off a real world home loan with Bitcoin, yeah, you just send your Bitcoin to Coinbase and then cash that out into your bank and pay off debt. So what I think you're asking, which is a really good question. Oh, real world debt. Yeah. Okay. Yeah, that's how you do it. So if you had a bunch of crypto, and say you even wanted to get a decentralized loan to pay off a loan in the real world, if you had a $500 loan from your bank, and you wanted to swap that out for a decentralized loan, you could say, okay, I'll take $1,000 of Ethereum, borrow $500 on MakerDAO, and then send that to Coinbase and from there to my bank and pay off my bank. And now your bank loan's paid off and you have a loan instead in MakerDAO. You could do that.
So you swapped out a real world loan for a decentralized finance loan.
Yep. Yeah. And if there's a difference in lending rate, then that could be great for you. If you're like, oh, I'm paying 20% on this credit card loan, but I have some crypto collateral. Okay, you get a crypto loan, pay off your credit card loan, and now you're paying a much lower interest rate. So that would be like a great way where you could reduce your loan, your debt burden.
How to refinance yourself.
Yeah. Yeah.
We'll create a new workshop for that.
Yeah.
How to swap out all your debts into DeFi.
Yeah. Yeah. So, but to do so, Mandelaine, decentralized lending, in decentralized finance, does require collateral. So you would need some crypto collateral to do that. You couldn't get just like, I have nothing, but I'm going to borrow some money from decentralized finance, because the lenders need to be sure they'll, that you won't just take that money and never pay it back.
I guess one thing that's coming to mind here is the difference between the real world and DeFi. Oftentimes when you apply for a loan in the real world, they look at your credit score, they examine your income, right, and your ability to repay. But it seems like those mechanisms don't necessarily exist inside of DeFi, but rather, do you have existing collateral that we can lend against, right? And then at that point, yes, we're willing to give you this amount of of a loan,
Yep.
basically.
Yep. So a little bit more on this. Hey, you can borrow without a lender because you're minting a token, like I explained with the MakerDAO. There are some competing platforms that do something similar, and I just wanted to mention them. So one is called Liquidity,
How
and
do you spell that one?
LIQUITY. So
Okay.
like liquidity, but without the D
Okay.
part. So LU,
Liquidy.
yeah,
I'm
Liquidity.
going to write that in the chat just in case
Yeah,
anybody wants to.
it'll probably autocorrect you. There you go.
Liquidy.
So they're a decentralized lending protocol that's very similar to MakerDAO, where you're minting a stable coin with collateral rather than borrowing from another person. There's some pros and cons to MakerDAO versus Liquidity that we don't need to get into all of the details. Liquidity, I think, charges less interest than MakerDAO does, but MakerDAO accepts more types of collateral. Um,
So more versatile, higher rates. Less
yeah,
versatile, lower rates.
yeah. So Liquidity only takes Ethereum as collateral. MakerDAO, they take Ethereum and Bitcoin, and they actually have some real world real estate used as collateral. They have an agreement with a real estate company that's done some of that.
Interesting.
And then they have some other types of collateral too. So, um, and then there's a third one, and this one builds on MakerDAO in a really interesting way, and it's called Alchemics. And this, the first time I heard about it, I'm like, is that possible? Is this some kind of Ponzi scheme? But it is, and it's I think a really exciting
We're about to
protocol.
find out in
Yeah.
CryptoNITE.
So there's a protocol called Alchemics. So think it's doing the same thing as MakerDAO, only they were able to completely remove the risk of liquidation and the loans repay themselves over time. And so
This is one I still haven't wrapped my head around.
yeah, so weird. And a couple of things I'm about to talk about now, including this, are they might be more advanced topics. And so, but I still want to discuss them
Yeah.
at least briefly. So you've replaced liquidation risk with term risk. Basically, the length of time your loan takes to repay itself off is the risk there. And so you could think of it as a way of bringing forward yield you could have gotten on your Ethereum or on your DAI, etc.
Bringing forward from the future.
Yeah.
Okay.
So if I have Ethereum, I could lend it and earn some yield on it.
Mhm.
Well, what if I wanted to grab 5 years of that future yield I would have gotten over the course of 5 years, and I get it now, and in exchange I lock this up for a while and give up a portion of that yield. That's kind of what you're doing here, and the way they pull that off is they match in denomination what you're borrowing and lending, what you're borrowing with what your collateral is, not lending. So.
Okay.
So let's go back to the MakerDAO example, and I'll explain this. Is MakerDAO, you use some Ethereum to borrow something dollars. So if Ethereum drops relative to dollars, you could go underwater.
Mhm.
Well, what if you used Ethereum to borrow synthetic Ethereum? Well, if Ethereum falls in price, your collateral and your debt both fall in price, or if they go up in price. So you don't run the risk of going underwater.
Right.
And so you can do it with Ethereum, you can do it with DAI, so you can do it with dollars as well. So you say, okay, I'll lock this up. You have to be much more over collateralized actually than with MakerDAO. So it's like, $1,000 and borrow $100 or $200. And then you can borrow that, do what you want with it. And then that collateral you use stays locked up until the loan repays itself. What they do when you stick your collateral, so I stick my $1,000 of ETH into Alchemics, they take that and lend it or do other things to get yield on it. And they use that yield, they take a portion of it for themselves, and the rest they use to pay off the loan for you. So they're self-repaying loans without risk of liquidation, but your risk is lockup. If you're like, oh, I want to do something else with that money, and they're like, well, your loan's not going to repay itself for another 5 years. Sorry. That's your risk there.
Okay, so to recap that, right? I had $1,000 worth of ether that I put into Alchemics. They give me a loan of 100 of a token. Does it have to be Alchemics? What am I minting, I guess is the question.
What are you minting in Alchemics? So So currently they accept, they do loans on self-repaying loans with DAI and Ethereum.
Okay.
So if you're getting a DAI-based loan, you get a thing called ALUSD, and it's a stablecoin,
Hmm.
like USDC and DAI are. And if
So
you're
they're still minting stablecoins.
Mhm.
Okay.
With DAI, yes. With ETH, if you're using ETH to get a loan, you mint ALETH, and it's an ETH pegged token.
Okay.
So it's a token stable to ETH rather than stable to dollars. So they don't call it a stable coin; they'd call it synthetic Ethereum.
The point here, though, I think, is
Yeah.
that if I'm putting in ETH, I'm getting something pegged to the value of ETH. So
Yeah.
then the two vary together,
Yeah.
right? If I'm
Mhm.
putting in something that's a stable coin, I'm getting something that is another stable coin.
Yeah.
So the two vary together,
Yeah.
eliminating the liquidation risk.
Yeah, because you're not at risk of going underwater.
But because I put in so much more collateral, and they are able to go get a yield with that collateral, they can pay off the loan for me.
Yeah.
In a reasonable amount of time, right? Because if they were lending me $1,000 worth of whatever, that would take a long time to pay off, right? I think that is that part of the protocol.
Yeah. So I mean that's part of the risk. So the amount of time it takes to pay off depends on the yields they can get on it.
Mm,
So if yields fell off, then yeah, maybe the length that your collateral got locked up for extends.
got it.
Right now, stablecoin lending is giving better yields than Ethereum lending. So if you do it with DAI,
It'll pay off faster.
then with ETH, yeah,
Interesting.
yeah.
So that term is a self-repaying loan, which
Yeah.
is not something I had ever heard about
Yeah,
in traditional finance, which is very, it's not even intuitive at first until
Yeah.
you figure out exactly what's going on.
yeah,
But it is very cool. Like
Yeah.
it's an innovation of DeFi that I don't know if that, I mean, I guess that could exist in traditional finance, but doesn't to my knowledge.
yeah. That'd be an interesting thing for Wells Fargo to do.
So stepping back, this is an example of borrowing without a lender,
Yep. Mhm.
right?
In each of these cases, you are minting a synthetic asset, and that's the thing you're borrowing. And because of that, there is no lender on the other side.
Got it.
Yep.
So we have two types of borrowing. Either I borrow from another investor or a pool of investors who lend me a crypto asset, or I borrow from a protocol where I'm minting an asset that is not lent to me by another person.
Exactly. Yep. Yeah.
Okay.
Yep.
So we got real deep there in alchemics for a moment,
Mhm.
but if we can go over it again if we need to. But we're back at the high level now, right? This is borrowing without a lender.
Yeah. And as a step back, by the way, really quickly, one thing that I found super helpful when understanding kind of how some of this worked is if you understand if you understand four things, I think, then all the rest of decentralized finance makes a lot more sense. That is, what is Bitcoin and a blockchain? What is Ethereum and a smart contract? How does the MakerDAO create a stablecoin? And I tried to explain it there, but it can take some time to kind of like understand well. And then the last one is what's kind of basically how does like Uniswap or a DEX work? We'll get into that more later. But if you understand those four basic things, then like when I learned about alchemics, my understanding of MakerDAO helped me understand alchemics better when I learned about these. And so those are some basic things that if you're like, oh, if I can understand the basics of this thing, and you don't have to get into the technical aspects of it, but the basics of it, it can really help you understand when you hear about something new, kind of the mechanisms of how those things work.
Yeah, one thought that's coming to mind as you're talking is maybe we should create some written content around those four pillars, just to help people who are less familiar get up to speed on sort of the foundational items, so they can better understand an explanation like, hey, here's what alchemics is and what it does and how it accomplishes a self-repaying loan, right?
Yeah.
So that's something we'll look into for sure, I think.
Yeah, we'll put that together. Hey, by the way, Dr. David, that's a great question about like, could you raise capital for a startup with crypto? Yes, we'll talk about that in the general QA as well. And then Chipski, so it's like a CD where they give you all of your earned interest up front. Yeah, that's similar to what alchemics is. Yep. Yeah, very similar.
Where you're locking up your money for not a predetermined amount of time in this case, for however long it takes to pay it back amount of time, but they give you those returns up front. Exactly.
Yeah. It's very similar to that. So a bank could do that. They could say, hey, we'll give you a new kind of CD that's more attractive because instead of giving you $10 a month for 10 years, we'll take all of that money and just give it to you now, and then your CD will unlock once that's paid off. Yeah. Um, so I saw a comment. Oh, maybe who was it that said it's like gambling or something?
It's here at the bottom. Matterhorn 85
Oh,
sounds like a new and exciting way of gambling.
it's funny. Decentralized lending, I don't think of it much like gambling, especially if you're using these trusted protocols. What I do think about as more of a new and exciting form of gambling is some of these meme coins. Like I think that's kind of like Shiba,
Mhm.
or Shibu. Is it
Shiba
Shiba?
Inu,
Yeah,
right?
yeah, Shiba Inu. Like Shiba coin and some of these like kind of meme coins, trying to catch the meme. I think is kind of like, hey, this is a more fun type of lottery.
Yeah.
But I personally don't view decentralized lending that way, especially the established protocols that are doing it well. And they've, there have been some massive market meltdowns, and none of the protocols that I named went underwater. None of the lenders lost money. Some borrowers have gotten liquidated, yes, but like none of these protocols like went insolvent during any of these meltdowns. There's been a few of them. Um,
So yeah, we talked about the CD where they give you all of your earned interest up front. CSLR, you got to stick with it. That's the only way. It's not that easy. But and then Patty Ice, we did have a discussion last time about what are some of the significant risks, and chatted a little bit about how governments could create an issue for cryptocurrency by barring some of the on ramps, right?
yeah.
So entrance into crypto, if you're found investing in crypto, there's a punishment affixed to that, and that would prevent a lot of crypto activity without a doubt. One thing that we feel strongly about, however, though, is that governments can't stop the crypto themselves because of their decentralized nature, right? I don't know if you know the amount of ETH nodes out there right now, but
There's
it's a lot, right?
There's lots
All
of
over the
them,
world.
and yeah, and with proof of stake, a lot more, and more coming on all the time. So yeah, while they could not shut it down, truly, they could make it. They could greatly reduce its adoption potentially. I think there's going to be competitors there, and one of the things that kind of mitigates my fear of that aspect of risk is like there have been lots of incumbent industries that have been disrupted, and every one of those incumbent industries had power, political and monetary, like financial power, to try to stop the upstarts. But it happens, and so and there are some governments that have tried to get a competitive advantage by being really pro crypto, where some countries like Hungary and obviously El Salvador has gotten a lot of interest, or a lot of press lately, are saying, hey, we want to attract all these DeFi developers, and attract this new industry to be developed here. So that makes it less likely that it would just get stomped out in the world, in my opinion. Um,
But there's certainly some risk, right? It's not riskless activity without a doubt. Um, I do think that with recent developments like the IRS partnering with TaxBit, for example, which is actually a Utah startup for calculating your tax obligation on cryptocurrency, right?
mm,
I think it's safe to say that there's some evidence that the U.S. government position is that they see themselves making a pretty penny on taxes in crypto, right? Um, so right now, it doesn't look like there's a ton of risk where at least the U.S. government is going to attempt to stomp out cryptocurrency,
yeah.
in my view.
Yeah, that's an interesting topic, and there's some uncertainty for sure. The more people who adopt it and things, I think it reduces the risk for sure.
Yeah.
Caesar had some good jokes. We are
Yes.
speaking English, and sorry to see you go. Um,
CSLR is a regular in the Brotherhood, and so
oh,
he'll come and go.
nice.
But
By the way, there is one other quick kind of novel type of lending in decentralized finance, and I want to just touch on it. It's even more sci-fi than the alchemic stuff. Really hard to wrap your head around, and there's pros and cons to it. I think overall it's much more pros than cons, but they are called flash loans. And there's a few protocols that allow for it. Aave does. MakerDAO just started allowing, well, they call them flash mints. But Aave will allow you to borrow an insanely large amount of money with no collateral, so long as you borrow and repay with interest in the same block. So going back to what we talked about last chain, a blockchain is it's a ledger where you can append new transactions on, but you can never change the past. And the new transactions that get appended on every few minutes are called blocks. So a block is a bundle of transactions that got added to the blockchain. So if you borrowed money in this block and paid it back in the same block,
So that's a few minutes.
yeah, it's like a fraction, like once the block is getting appended on or is created, it's less, it's seconds or milliseconds or whatever.
Wow.
You could borrow $500 million if you pay back the $500 million and interest in the same block, because there's a guarantee, because it all happened within a block. There's a guarantee they get their money back. They don't need you to have collateral. It's a really weird thing. It's actually been used for some exploits. That's why some people don't like it, and they say, hey, this shouldn't even be a thing, because there have been exploits done where you're like, hey, there's an exploit, and I can make a ton of money if I borrow $500 million and boom, exploit it all at once. For that same reason, these systems have, because they know they need to be robust against flash loans, it makes them robust against all other kinds of many different types of manipulation
That can happen within a block,
yeah,
right?
yeah. Like say you had one person with $500 million that wanted to like mess with your protocol. You're like, hey, I'm already robust to flash loans. I'm gonna be robust to this as well, because that's less extreme than a flash loan.
Interesting.
There's some good reasons why they should exist. I won't get into all of that, and it's really weird to think about how you could borrow and repay with interest in a single block. I just wanted people to be aware that's a thing. And for the, we can get more into that another time. It's not something that any of you are likely to ever use. I'm unlikely to use it. People tend to use it with bots. And anyway, we won't get real deep into that.
Okay. Yeah. That's very interesting. A couple of questions come up for me, but I think I'll save them for a future session. So I think we've reached the point where we can kind of start just general Q&A, right?
Yeah,
and just focus exclusively on the questions.
Yeah, I'm seeing some great questions come through now, but to be fair, let's go back. There were some early questions.
Let's scroll up. We had we were going to talk about staking.
Yeah, staking. So Brenton, you asked, is decentralized lending like staking, or is that different? So there are a few different things people mean when they say staking. The most common is like Ethereum staking is becoming a big thing. And then there's another type I'll talk about in a second. So Ethereum staking, right now, Ethereum and Bitcoin are using a thing called proof of work, which to secure the blockchain, to keep it from being modified. And proof of work uses a lot of computation power. So people have a warehouse full of high-powered computers burning a lot of electricity to keep the blockchain safe. Proof of stake uses much less computation power, like 99% less and 99% less electricity, but validators, the computers that validate the blockchain now, they have to have some Ethereum that they put at stake, and if they're found to be a bad actor, they could lose that stake. And so the idea here is you say, okay, I have 32 Ethereum, I will put it into staking, and I will help secure the Ethereum blockchain, and in exchange, I'll get some Ethereum.
Staking is currently, in its current iteration, does require you to lock up your Ethereum for a period of time that could be up to a year, right? Or longer.
Yes, if you're running.
It sounds like it's going to be shorter, but right now it's, unknown exactly how long you don't have access to your Ether once you commit it to staking.
Yep. So there's this lockup period, but you get returns for that. And there's some people in this chat who are staking that I know, and I won't call you out if you don't want to be called out. But it's a way of securing the Ethereum blockchain, and you're getting paid for providing that security. And the great thing about staking, if you want to do mining, you have to buy these really expensive GPUs and burn a lot of electricity, etc. If you want to stake, you could do it with like an average laptop. That's the amount of computation power you need, and you could just run it at home. It wouldn't create a lot of heat. But you need a certain amount of Ethereum, and it happens to be 32 Ethereum to run a staking node. So that's Ethereum staking. There is another type of staking you'll hear about in decentralized finance, and that is SushiSwap does it, Alpha, Homora does it, and some others do it, where if you have Sushi tokens, you can stake them in Sushi, and then the Sushi protocol earnings are Sushi stakers are the people who are getting paid basically a dividend from protocol earnings. Same with Alpha.
Yeah, let me pause. We haven't talked much about Sushi in this episode. Sushi is a decentralized exchange.
Yep.
So it's built on top of the Ethereum blockchain. You're able to exchange tokens within it, and you're able to provide liquidity, which is something I'll go into later. But that's what Sushi is. So within Sushi, you can stake. If you own the Sushi token, right, in essence, owning some stock of Sushi, and you stake it, you then become entitled to these dividend payments, which are really just returns accruing back to the stakers, right?
Yep. And the way they do that, just if you care to know, is Sushi Swap. The protocol itself takes a portion of these trade fees, and they take that money and they use it to buy Sushi tokens, and they gave those Sushi tokens to Sushi stakers. So you're earning Sushi on top of your Sushi. You're earning more of that native asset.
And if you like to eat sushi, the amount of times we're going to say sushi isn't going to go down probably. So
Yep.
Prior to next CryptoNITE episode, you might want to have some available.
Yeah. So it's like a dividend yield. It's like, hey, I own Sushi tokens. I make money when Sushi token goes up in price, and I also make money even if it stays flat
because of all the trading fees.
Yep. And Alpha does the same. I do a little bit of staking in both. Actually, I stake some Sushi, I stake some Alpha, if you care to know, and they give you some yield that is proportional to the earnings the protocol is getting, which is great. So that was the staking question.
Could we use cryptocurrency to raise capital for a startup, from Dr. David?
Yeah. Great question, David. Or maybe it's Doctor. So yes. You could think of these DeFi protocols themselves as startups. And in 2017, 2018, the way that kind of new DeFi protocols were raising money is they were doing these things called initial coin offerings, where they said, okay, we created our own token.
ICO for short, initial coin offering.
Yep. They're like, hey, here's our token. And we'll write a little smart contract that says, if you send us Ethereum, we'll send you back some of our token. And then that token's going to be valuable when we build stuff. And I actually participated in some. They didn't turn out super well. And so people sent them money. They used that money to fund their startup. And almost all of those ICOs ended up faring really badly. Most of them didn't even launch a product, and most of them that didn't launch a product that got any traction. The way DeFi teams tend to work now, which I like a lot better, is they just go and build kind of the very first version of it themselves. And then they say, hey, we will give you some of our native token if you use our protocol. And so then you're like, oh, if I go lend on Aave, I'll get some Aave tokens for my time. And they'll do that for some period of time to incentivize you to use their protocol. And then they will hold some of the tokens for themselves. Like, okay, 80% of our Aave tokens we're going to just give to people who use it. And that'll run out over the course of a year or two or whatever. And then 20% we'll keep for ourselves. And then if Aave gets used and the value of the token goes up, then we can use that to fund our operations. So that's being done currently.
So adoption funding rather than, fund based on a promise of a future product.
Yeah. I like it better. It seems like it has incentivized a more kind of like positive ecosystem. So that's how that's being done now. There's other ways you could use cryptocurrency to raise capital for startups. There's ways you could use cryptocurrency to raise capital for startups even that are not in DeFi, but those are like kind of the common ways that's being done currently.
It's a good question.
Yeah, thanks for the question, David.
So moving
Dave,
down here.
It's Dave D. Sorry, Dave.
Dr. Dave D. There you
go. Let's see.
Thoughts on Cardano? We touched on that briefly last time.
Yeah, happy to share again.
Yep, go for it.
So I'll give you my brief history with Cardano. I actually bought some Cardano back in 2017, maybe it was 2018, and held on to it for a few years and ended up selling it maybe a year-ish ago. And it's a lot of why I sold it is because my paradigm changed. So back in the 2017 era of ICOs and all of that, I was mostly holding Ethereum, but I was like, I'll buy some of these things and see if those promises come to fruition. And basically none of them did. And now, because we have such a thriving DeFi ecosystem where you have protocols with like $10 billion being used in their system and generating revenue and solving real problems.
This is a point that I wanted to make, right? Without being familiar with DeFi, I think people are prone to assuming that it's very fringe. But like $10 billion is not a small amount of money,
Yeah.
right? And the amount of money already flowing through DeFi is kind of astonishing to think
Yeah.
about, especially with a large majority of the population having no idea what it even is.
Yeah.
Right. I've sort of realized that most people have heard of Bitcoin, less people have heard about Ethereum. Almost no one has heard about DeFi.
Yeah.
Right. It's this thriving ecosystem built on top of the Ethereum blockchain. There's huge upgrades coming to that blockchain in the coming years. It really has a lot of promise, and there's already a lot of adoption. So it's a really cool thing to be learning about.
Yeah, there are at least a dozen decentralized finance protocols with $1 billion or more being used in their system. So because there's real problems being solved at scale there, my paradigm changed, and I was kind of like, look, now I'm just going to invest in protocols that meet like a few criteria for me. It's solving a real problem, it's doing it at scale, it's getting growth, and then there's some questions about like, okay, does adoption of the protocol have some kind of value that accrues back to the token holder, right? And Cardano they don't have smart contracts yet, and they were launched a long time ago, clear back 2017, maybe even 2016, and they've been promising smart contracts for a long time. Without smart contracts, you can't build DeFi, you can't build anything else. And
it's basically a Bitcoin clone until they graduate to smart contracts.
Yeah, better than Bitcoin in some ways because it's using something better than the Bitcoin mining approach and some things like that. And there's a counter view to that too, that we won't get into. There's a view of why Bitcoin's approach is better, but Cardano is intending to be a platform like Ethereum is, where decentralized finance gets built, etc. So my take on Cardano is, when Cardano launches smart contracts and people build DeFi protocols on there, and those protocols get usage, then I'll consider investing. But right now, 99% of the things that could be built on a smart contract platform are built on Ethereum, with a tiny little fraction being built on a few other places like Solana and Cosmos and maybe Polkadot, and Cardano doesn't have any yet. So I wish the Cardano founder and their devs the best. I hope they succeed. I personally have avoided lately investing in anything that is promises and not delivery. So I'm not invested. But like I said, I would reinvest if they got some DeFi adoption. But you're gonna have to attract developers, get them to build, and you're gonna have to attract users, and doing that against the gravity of Ethereum is gonna be hard, but it might be possible. If it happens, then I would put some money in there. So thanks for the question, Patty.
So Dr. Dave D, kind of following up on the previous question, isn't there a real risk because you are trying to disrupt an entire industry that is the foundation of monetary policy?
That's a great question. Oh, and sorry, we had skipped over that for the other just now. Yeah, so you could make an argument that finance is a harder industry to disrupt than, I don't know, the auto industry. That's disruption. A lot of times, though, the disruptors a lot of times get ignored until it's too late. That's how disruption tends to happen. I think that's kind of been happening in DeFi.
It's kind of an idea from Clayton Christensen,
Yeah,
right?
Clayton,
With
yeah.
disruptive innovation.
Yeah. So, yeah, that's a good in-depth thing. And actually, maybe because this has been brought up twice now about this risk, maybe we could kind of gather some thoughts and talk about it a little bit more in depth on another episode. But yeah, I think there's a real risk there. I think that risk goes down over time as adoption grows, and especially as some of the banks and financial institutions just start adopting crypto themselves to facilitate greater efficiency. So Visa and MasterCard have already come out this year and said, hey, we're going to start settling some of our transactions to the Ethereum blockchain, specifically with stablecoin transactions. So there are credit cards you can get where you're buying and selling, not you're buying and selling, you're buying things on that credit card using USDC, which is a stablecoin, and Visa is settling those transactions to the Ethereum blockchain. Benefits the user, benefits Visa in some ways. and those benefits will grow as scaling gets better. We'll probably have a whole episode on scaling.
Yep.
But Visa's starting to adopt it, and MasterCard is, and then if you have more and more financial institutions themselves adopting it, then the risk of it just getting stomped out by incumbents gets harder.
And another point that I want to make here is it comes down to how incentives work, right? When you think about cryptocurrency, they're already multinational, they're global even, right? They're not blocked off. Nobody is blocked from participating in cryptocurrency. One of the points that we touched on last week actually is that cryptocurrency allows non-U.S. citizens to participate in the U.S. market, and there's nothing the government can do about it, right? It's a very interesting thought. But as power dynamics shift, right? You see a country like El Salvador saying, we're going to go all in on crypto. It becomes a little tougher, right, to quash the entire system at a global level, where different countries can be compared to different companies in a competitive ecospace, behave differently because of different cost curves, different economic realities that cause them to be incentivized to a greater degree to adopt or accept or build on crypto. And all of those activities simply increase adoption, making it harder again to stop it, right? In some ways, crypto, in my view, seems like a snowball that's gaining a little bit more traction day by day, right? More people leveraging these decentralized protocols, more people realizing the power of what's going on here, more people simply coming to the realization that putting money in a savings account is an easy way to lose money, and putting money in a crypto protocol is an easy way of gaining some of the yields that the bank often gains, right? When I put my money in a savings account, like, there's a lot of powerful ideas and a lot of powerful projects, protocols, I should say, being built. And I think that at a global level, it's almost too hard to stop, right? To reiterate one of Rhett's bear case scenarios for Ethereum that I've heard, there is the possibility that the United States government or another powerful government could really disrupt the flow of Ethereum by purchasing, how did you word this? Purchasing a lot of the mining power, and then repeatedly executing what's called 51% attacks, which are the main risk each blockchain has, which is if you can fool 51% of the computers maintaining the blockchain into thinking a transaction happened enough times, you can't fix it, right?
Yeah, so there's 51% attacks are an interesting whole topic of themselves, but yeah, so if you have more than 50% of the mining hash power, then you can change past transactions, which is undermining the very purpose of a blockchain. So yeah, you could say, but there's some details there that we don't have to get into now, but if the U.S. grabbed a bunch of compute power and started 51% attacking, that would be a problem. As the network grows and decentralizes and moves to proof of stake, that becomes harder and harder and eventually impossible. And it's already, I think, near impossible. But that's something that could happen. Those are real risks that I think are diminishing over time. And I already consider them quite small risks, but they're not zero. So we've got some other really good questions here. So how can the government regulate something so decentralized? What you could do, and they can't regulate Ethereum. Ethereum's a decentralized protocol, and it's being mined by various people, and who knows who they are across the globe. But what you could do is say, we are going to ban its use, and then Amazon won't take payment in it. And we're going to tell Coinbase that you're not allowed to connect to banks anymore, and so I can't move anything from my Wells Fargo into Coinbase. So there's some things. So those are some things you could do.
We've referred to those types of activities as on-ramps.
Yeah.
Right? That's where the target would be if you're attempting to regulate it. You can't regulate it directly, so you target the on-ramps. What are the ways that people interact with the cryptocurrencies, and how can we stop or regulate those?
Yeah.
Right.
And you could tell people, hey, if we find out that you own any cryptocurrency, we'll arrest you or something. Just like if they find out I own like a kilo of some illegal drug or something. So that's a way that you could approach that. There's a really whales can hurt the market badly. That's an interesting point, Brenton. and that's possible. They can also help it. Um, so Paul has a really good question here. Really glad to have you, Paul. Paul, by the way, has an awesome YouTube channel called "It's Just Astronomical," where he talks about. He does a really good job of breaking down like astronomy into really simple things.
I'm
So
definitely going to follow that.
yeah, yeah,
I am an astronomy nut.
yeah. All of
I
you
just
should.
wanted to
All of you should.
I just wanted to go ahead and toss Rhett's Twitter into the chat. I did that a few times last time. I feel fortunate to know somebody who understands so much about DeFi so that I can understand faster. And I think it's only fair that, you know, if you're trying to learn more about DeFi, Rhett is very active on Twitter. Give him a follow. He's interacting with a lot of the protocols, a lot of the development teams, even for these protocols, and it's a great way to get more exposure to what's going on in that space. There's a very active Twitter community around DeFi, and following Rhett is an easy, logical step to beginning to learn. For example, I'll tell you a fun story. Rhett posted about something and used the term NGMI, and I had no idea what that meant, and it turns out it means not going to make it. So because I followed Rhett, I learned what NGMI means, and now anytime anybody else talks about a DeFi token in that context, I know what it means. So
Yeah.
it's one step at a time.
I don't know if that term is specific to crypto, but I hear it a lot in there, and it's talking about investors who are like, I don't know, making bad decisions, like, oh, you're not going to make it.
Yeah. So I mean,
That's funny.
that's helpful. I didn't understand until I
Yeah.
followed Rhett. So that's kind of where I'm going, right? There's lots of topics you'll be exposed to, and you'll be able to learn faster.
Yeah.
Right?
As a quick aside, I've been putting together a list of good crypto Twitter people to follow. Like Vitalik Buterin is a good one. He's the founder of Ethereum, and we'll end up putting it in here. I was completely inactive on Twitter until I started getting into crypto, but there's a lot of that happening there. So I'm gonna put together a list of like people better than me to follow. So, but Paul, I want to get to your question. This is a really good one, and I actually want to do a whole episode on this. So you're right. Anyone who's interacted with decentralized finance knows that um, transaction fees can be quite high, and that's because Ethereum can only settle so many transactions at a time right now, and there's a lot of demand for its use. And so, you swap a token, it might cost you $20.
The common metric there is TPS, right? Transactions per second.
That gets talked about. Yeah, that's one aspect of it. Yeah, and so there's a few different ways to look at that, but that's one thing that gets talked about. And so Ethereum can only settle so many transactions, and there's a lot of people wanting to use these protocols, and so you might spend a lot of money
just moving your money.
Yeah, yeah, and that can be problematic, and it has been a block to mass adoption, especially the cost to transact on Ethereum goes up the more complex the smart contract you're interacting with. So if I just swap one asset for another on a decentralized exchange, it's not that much. But if I try to deposit into a really complex protocol, it might cost me a lot. So yeah, there are some really awesome things happening here, Paul. So the big one, and it's actually happening as we speak. There's two major ones about to launch, like within the next month probably, and they call it layer 2 scaling. So this is scaling one layer up from the Ethereum blockchain itself, and the most common type is rollups. It's a way of bundling a bunch of transactions into together, and then they transact as one transaction on the Ethereum blockchain. If you are on a roll-up transacting rather than transacting at the base layer, and we'll have episodes about this and show people how to do it, the cost reduction they figure will be somewhere between 20 and 1,000x, depending on how some things play out. So like if you're paying $20 right now, you'd pay $1. In kind of the worst case scenario, you might pay 20 cents. And so that will be a big improvement. And then the base layer Ethereum blockchain itself is going through two major upgrades, both of which will help one a lot more than the other. So Ethereum 2.0, they call it, is a migration to proof of stake, which we've talked about a few times, in addition to a thing called sharding. Sharding basically breaks the blockchain into 64 shards, or like, little kind of clones that all interact with each other. And it has a 64x improvement. And so if you multiply sharding by what's happening with rollups, it's something like a 10,000x improvement in throughput. Those two together should bring the cost per transaction down to pennies or less. And like I said, rollups are happening now. Probably the first two rollup solutions, Arbitrum and Optimism, will roll out within the next few weeks or month. And then sharding should happen within the next year-ish. And like I said, those multiply together. So
And the other one question related to that is when sharding rolls out, that's also when staked ether will become unlocked. Is that correct?
I think that's right. Yeah. And then roadblocks, Paul. Rollups. There are actually other layer 2 scaling solutions. There's things called there's a thing called plasma, and there's a thing called state channels, and they have pros and cons. Rollups the technology needed to be developed and tested and all of that, and a lot of those rollups have been under development for multiple years. That's kind of like that portion is done, and like I said, multiple of those are rolling out now. And there's two different types of rollups. We'll get into this in another episode, but there's pros and cons to those, and there's some really awesome things coming into the future.
I do want to touch on one thing about why I have confidence in Ethereum. Early on when I was mining more heavily, there were a lot of new currencies coming, and a lot of them professed to be Ethereum killers, purely on the basis that they could handle a lot more transactions, right? And one of the very interesting things that were happening at the time is the founder of Ethereum. How do you pronounce his name? Vitalik. I was definitely going to say it wrong. So Vitalik, I read some of his literature at the time, and he took a very measured approach to it. He said, Ethereum is going to get it right. So it might take us longer. And here we are years later, finally getting to those solutions, right? But a lot of those other currencies that had much higher throughput, had significant security risks associated with them. So they just were never going to be the solution of the future, despite the marketing hype around, hey, we can handle way more transactions than Ethereum, therefore we are going to win, right? And so I feel much more confident in Ethereum because of this growing history of being very measured, of testing everything thoroughly, right, before rolling it out. So that's given me a lot of confidence in these proposals, because I know, like Rhett said, they've been in development for years.
Yeah.
They were talking about them years ago. They were testing them years ago, and now they're finally going to roll them into the blockchain.
Yeah.
So it's really cool, actually.
Yeah. There's some really good literature, like he said, some publications by Vitalik and conversations with Vitalik that I'll also get some links for those. Vitalik actually, he's a surprisingly modest and humble guy for how amazing he is. Well, not even for how amazing he is. He's humble. He's like more humble and modest than me, and he's like maybe the smartest person in the world, I think. But he's like, yeah, it took longer than we thought. And so, like, to speak to that a little bit, Paul, like with staking, the staking part of ETH 2.0, it took them years of development, and then they finished it like a year before the Beacon chain launch, which happened last December. They took like a year of testing it, basically, and then they launched that. And right now it's running in parallel to mining, staking and mining, and that will merge in late this year, early next year. And they're just being very careful with that rollout to make sure that they didn't get anything wrong. And so that, staking has been happening in parallel to mining since last December. It has had not a single hiccup, but they're just being really careful about that movement. And then sharding is more complex than the staking portion. My understanding is that development for sharding is essentially done, and they're kind of in the testing phase for that too. You can look at the Ethereum Foundation and they'll show where they are with that, but all of the research work is done for sharding. Most of the development work is done, maybe all of it. I think there's maybe a few more things they're doing, and then that's going to be tested for a while too. So sharding won't launch this year. It'll probably launch maybe mid next year or something. But roll-ups and some of the other scaling solutions, like I said, state channels and plasma, etc., those will hold us over for a while. Like 100x scaling while we wait for another 100x scaling that will multiply together is going to hold us over. So there's some technical complexity there, Paul, and Paul's an engineer and also way really smart. So you'll probably understand some of that better than I will, and I can send you some stuff on that.
Awesome question. I'll take the next one. Huguenot, how would you explain the blockchain to a 5-year-old? Let's see if I can do this. So the way that I would explain the blockchain to a 5-year-old is that it's literally a chain of blocks. And in each block is a record of all the transactions that occurred in the last few minutes.
Yep.
That's it, right? So
yeah, that's good.
To zoom out a little bit, right? The Ethereum network is a network of computers, and all of those computers have a copy of that ledger or the blockchain saved on them. And every single one of those computers agrees that all of the transactions that took place in the last few minutes happened. When that happens, the block gets appended to the blockchain, and that becomes part of the history of transactions. That is how we can know where digital tokens are, right? Instead of being confused about, okay, well, I sent the crypto here, but I also did it here. That can't happen because all of the nodes or the computers on the network must agree about where crypto was sent or transacted. And that is why blockchains over time get huge, right? Downloading the entire Ethereum blockchain now takes hours and hours. Even with a fast internet connection and a very fast hard drive, it takes hours and hours, potentially days, because there's so much data there.
Yeah.
So that is how I would explain the blockchain to a 5-year-old. Would you add anything, Rhett?
That's actually a technical problem they're working on, the growing nature of it. But yeah, the way that I would put it, if I was talking to a 5-year-old, is like, okay, hey, say you and I, sometimes like I want to buy, some ice cream from you, and you want to buy some shoes from me or whatever. We're transacting together, and we want to just keep track of like how much we paid each other. A blockchain would be like if we kept that in a journal, and it was like once you're like, okay, Rhett paid Phil $5 for this, that entry can't be changed. It's like, hey, once we make that entry, we agree on it, that's set in stone, and then we can do another. So it's just it's a record of transactions between parties that can't be changed. So I guess that's how I would put it. Let's see.
I did want to touch on the 1 to 3 month stake options on Crypto.com by Patty Ice, bro. I think the key thing to remember is that the only way to stake directly with the Ethereum blockchain is to lock it up and to have at least 32 Ethereum. So anything else, whether it's a pool or another protocol or introduces a middleman, right? It's somebody that's going to increase your liquidity for you in exchange for some return for them, right? So I don't know what's going on Crypto.com, but I would assume that since there's only one way to stake Ether, that they are using some of their own liquidity to provide liquidity for you and taking some of the returns in exchange. What would you say about that?
Yeah, so there are these things called staking pools. You can, you're like, hey, I don't want to figure out how to do this and do it on my own computer at home. That's a lot of work. I just want someone else to do it for me.
Or I don't want to lock it up for a year,
yeah.
right? That's another problem that staking pools can solve.
Yeah. So if you stake it at home by yourself, it gets locked up for a year. But if you stake it through Coinbase, well, Coinbase still locks it up. But you can stake through Coinbase in their pool. They take part of your returns for doing it for you. Kraken will do it to their competitor Coinbase. Crypto.com will do it. There's actually decentralized staking pools, like in the DeFi world. Like there's one called Lido, and theirs has 0 lockup period. If you swap out some ETH with ST ETH, that's their staked ETH. That ST ETH represents some staked ETH plus the yield that it's getting, but it's completely liquid. I could send that ST ETH to Phil. I could sell it. I could do whatever I want with it. So there's no staking period because you might call it a staking derivative.
But Lido is taking a portion of the staking returns in this instance, right?
Mm-hmm. Yep.
So
you're always giving something up and you're getting something in return.
Yeah. The other thing that I wanted to say is in the ICO era, right? Or even with all of the altcoins that have risen and gone to zero, there are so many shady actors on the fringe of the crypto world, right? So it's always smart to look for trusted protocols, look for trusted currencies, and interact directly wherever possible. And if you don't, you really want to know a lot about what you're doing, what you're getting yourself into, right?
Yeah.
Because the money can go away. Um, some of the terms used last episode were rug pull, right?
Yeah.
You send your money to a protocol or to a company, and they leave with it, right? Like there's risk associated with uh, getting a there's risks associated with convenience, I should say,
Yeah.
where if I don't have 32 ether, so I can't stake, so I'm going to go into a pool. There's risks associated with going to a pool, so you don't want to go to any pool. You want to go to the most trusted pool that has the most information about the development team, or has the most information about from auditing or whatever you know mitigations you can come up with about why you're not going to lose your assets, right?
Yeah.
So that's kind of the key, right? As you're interacting with anything in crypto, Rhett's mentioned this repeatedly, right? Trusted protocols. There are a lot more protocols than the trusted ones that we're talking about.
Yeah.
And they're not trusted for a reason, right?
Yeah. Yeah. So like, for instance, if you want, like, there's a handful of rules that'll keep you safe. One is don't interact with a protocol that doesn't have its smart contracts audited. That's base layer. Um, and then, another way you could look at it is say, okay, if I go to like DeFiPulse.com, they show kind of like the biggest DeFi protocols, and you say, okay, I'm mostly going to interact with the ones that are the biggest. They've been around, like MakerDAO. It's been around a long time. It has $6 billion being used in it. They're audited. They have like a long track record. And so you'd say, okay, I'm going to keep my activity into those protocols. That'll keep you a lot safer than trying to chase after some brand new token with no audits on its smart contracts. That can be scary.
But if you are looking to take on more risk, right, there's still other research that you can do to mitigate some of that risk. What's the development team's history?
Yeah.
What other projects have they participated in? How did those projects go?
Yeah, like this guy actually helped build MakerDAO. He's really trusted. He's really, blah, blah, blah. And they're going through some smart contract audits and things. And, so that, you could look at it that way if you want to go down that long tail. I think for most people, you don't need to go down the long tail. So let's see. Chipsky, I really liked your explained to a 5-year-old. That's really good. I think people could benefit from an explanation on token versus coin if we have time. Yeah, that's a good question.
That is an interesting question. I feel like the terms are used not interchangeably, but that there's a formal definition of them that doesn't necessarily match how people use them in practice.
Yeah, I don't know that I would even distinguish between them really. Like, is Ethereum a token or a coin? I tend to call them tokens. Honestly, I think this is mostly like just how people commonly refer to things. So I tend to call all these crypto assets tokens. Some people call them coins. I don't know that there's.
I mean, I'd venture a guess that the term coin came up because the first crypto ever was Bitcoin.
Yeah.
And so people thought of them as coins, right? Litecoin was the second one, was it not? Dogecoin. There were a lot of coins early on in crypto's history. So I think that term was just easy to use and adopt.
Yeah. Yeah, token might be more general, where it's like, okay, it's things you think of like coins like Bitcoin that are trying to be currency-like in some way, but it also applies to NFTs, which are we'll get into, and these DeFi tokens.
NFT is non-fungible token. It's literally called a token, right?
Yeah.
And also the ERC20 tokens are explicitly referred to as tokens. So I think that's I wouldn't call an ERC20 token a coin.
Yeah.
Right.
Yeah. So if it's trying to be a currency, maybe it's a coin. That might be a way to look at it. Are there derivatives in DeFi? Yes, there are. Actually, there are options. There are futures. There are other types of derivatives. I would call a lot of the synthetic assets derivatives, where it's like, oh, this thing is tracking the price of X. You can think of that derivative like. So options and futures, really briefly, for those who are more in finance and interested, what you'll see most commonly in DeFi are what are called perpetuals. Some people call them perps. They're called, the full name is perpetual futures contracts. So it's like a futures contract that never expires. The biggest uh, place that's happening in DeFi is a protocol called Perpetual Protocol. Something like 80% of all perpetual activities happening there. There's another one called DYDX. They're a perpetuals exchange, basically.
That's a nice math name
Yeah.
for a derivative.
Yep. And then there are options. Hegic is one, HEGIC. They trade in options. DopeX also just launched, and they'll be doing options, DOPEX. Those are options. There are some other things happening within derivatives too. We could have a whole episode on derivatives, actually. That would be a good conversation. Derivatives, crypto derivatives are illegal in the US. So actually a lot of these protocols, if they see your IP address is in the US, they'll say, hey, we're not going to let you trade here. And so you'd have to figure out a way around that if you wanted to do that, or head down to Mexico or up to Canada. I don't know which of them, if either of them ban it. But
I've heard that they're close to again, this has been attempted a few times in the US, right, to legalize crypto futures.
yeah,
I recently read a story that they're kind of on the cusp again, but I'm not sure it's going to go through.
yeah, that'll be interesting to see. Yeah, so derivatives. China seems to be a government that wants to control DeFi, Dr. Dave D. So that's a good question. They've seemed really hostile actually to it. A large portion of the crypto mining, especially Bitcoin mining, up until now was happening in China. They were early adopters of crypto. China's like shut down almost all of their mining. A bunch of them moved to Texas. They actually blocked on ramps like we were discussing. A bunch of Chinese people sold. A lot of them have there's Chinese people who have left China over it, or moved states. So I think they're just hostile to it in general, which you know, at, let's be honest, they're kind of a totalitarian state, so they want a lot of control. So they're not trying to control DeFi; they're trying to stamp it out themselves. So it's moving away.
I've read that they're interested in their own digital currency,
Yeah.
which I could see. They've monitored kind of how it works for a while.
Yeah.
They've determined that it's incompatible with the way they want to run the country, and I could see them imitating it.
Yeah.
In a more controlled fashion.
Yeah. Yeah. I won't get into all the reasons why now, but actually I think digital government currencies would be really bullish for crypto, for DeFi. Like a digital dollar from the US government would be it'd almost certainly smooth on ramps into DeFi, so it'd end up being really positive.
Yeah.
Patty, another question: where do you get your daily updates, crypto news from? Great question. Yeah, we're gonna put together a whole list. There's a handful of podcasts I listen to basically every episode. There's one called The Daily Gwei, GWEI. He does a daily half-hour recap of Ethereum ecosystem stuff. It's great. Anthony Sassano's his name. There's Bankless, which is really good. There's Unchained, that's really good. We talked about some of these before. Uncommon Core, it's a little bit deeper. And then when if there's ever some big like Ethereum conference or things, I'll usually go watch the videos from that. There's one on a thing called MEV recently. I watched 8 hours of videos on that, and it's really interesting, good stuff. And also crypto Twitter. I was not a Twitter participant until I got into crypto. A lot of crypto protocols and people are pretty active in Twitter. And then the other thing is Discord, which is, for those not familiar with Discord, it's a chat app. It's kind of like Slack. Most DeFi protocols have a Discord channel. I'm a participant in many of them, and if you're trying to interact with their protocol, or you're asking questions or whatever, you can just hop in their Discord channel and start asking questions. And usually, communities are really great and will answer your questions and help you out. And I've participated in a lot of those and helped people out. I was so active in one of them, some people started being like, "Hey, are you guys going to be able to do this?" Tagging me. I'm like, I'm not on the team, but those are some great places to get kind of daily info.
Yeah, that is a good question. You had mentioned a 30-minute daily podcast on crypto last time. I plan on beginning to listen to that myself.
Yeah. Daily Gwei. Yeah, that one's great.
Daily Gwei.
Mm-hmm.
Okay.
Yeah. Mm-hmm. And then what books did you read to educate yourself? There's a number of good books on the topic. And I'm actually blanking on names. But I'll put together a reading list in that way too. Also, there are what are called white. There's a lot of white papers. So like Bitcoin, when it first launched, there's a white paper explaining kind of like what Bitcoin is. Every protocol that launches, if you want to do deep diving about those protocols, reading their white papers is good. That can be heavy reading.
Yeah.
But there's some good actual written books that I've read on the topic. And again, I'm just forgetting names. Since you put me on the spot, I'll put together a list.
Yeah, we're putting some of that stuff together. We're probably going to host it in a Google Sheet just to start off, and we'll post links to those things under the channel, which will be easy. You can always come visit the channel, click on the links, and we'll try to migrate that to something better over time. And I can also pin them in our Crypto Gurus channel in the Brotherhood Discord. So, great question, Hugh Jackman. I think many of us share that sentiment. It is a very interesting name.
Yeah.
What can we do about it?
Yeah.
I mean, it's certainly 64x transactions.
64 shards, just like Brandon Sanderson novels talk about. His are 16. Just kidding. I just outed myself as the biggest nerd. So Matt Horn, great question about the flippening, where ETH surpasses Bitcoin. I think there will be a flippening. I'd be very surprised if they weren't. Bitcoin's kind of trying to be digital gold, and it may succeed, and I'm not against that. And what's gold's market cap? $11 trillion or something like that, 10, 11 trillion. But ETH is going to be having entire ecosystems built on top of it. Decentralized finance, it's going after all of finance. It's also a store of value, kind of competing with gold and silver and those things. And then you have the whole NFT thing and like whole other industries that haven't even been conceived of yet. All of that value, if Ethereum isn't much larger in market cap than Bitcoin in a decade, I'd be personally surprised. That's my own take. But Dad, I'm 5 out understand what you just said. Yeah,
I did my best, Matt.
Yeah, we're trying. Hopefully, we'll improve over time.
It was more of a 10-year-old explanation, but we're gonna get to the explain like I'm 5. Don't worry.
How much interest do you make when with 32 ETH staking yourself? So that depends on a few factors, and interest rates right now are something like, what is it like?
I'm not sure what they are. I checked them when they initially started, right? And I think there's a curve that rewards follow, because there's a limited number of rewards. So the more people that are staking, the smaller the reward will be for the whole. You can actually look at the current rate exactly. 6%. Thank you, Matterhorn. You can go look at the exact rate on the Ethereum 2.0 website, where they talk about here's the upgrades that the blockchain is going through over the next, in the last few years and going forward until they reach full proof of stake.
Yeah.
But the staking mechanism was wildly successful. Like they needed some amount, I can't remember off the top of my head, they needed to get to some amount to start it off. They blew past it in the first week, and people have continued to add Ethereum to Ethereum 2.0 and stake it.
Yeah.
And so those returns have dropped, right? Yeah. But they're not negligible, right? They are definitely not the 0.12% I can get in a CD today.
Yep. And they're in a better asset than dollars, in my opinion. But the other thing, too, to note about this staking merge, thanks for the link, Matterhorn. What was I going to say? I lost my train of thought for a second. So right now, staking and mining are happening in parallel, and there are two types of rewards that are being paid. There's block rewards. This is newly minted Ethereum. Some of that's going to miners, some of it's going to stakers. Most is going to miners. And then there's transaction fees. Right now, all of that's going to miners. When they merge and mining is shut off, all of the block rewards and fees will go to stakers. The interest rate, the yield you earn on staking should go way up unless like millions more ETH get staked, like many millions more. So I expect it to hover around this until the merge, and then you should see yields go up, and then that will probably cause a lot more people to stake. So that's kind of what I expect to happen there.
It's a smart strategy for adoption of staking, at least.
Yeah, and the more that's staked, the more secure the blockchain. So it's good. Everyone benefits. More security, better DeFi. And then, okay, thanks for the YouTube video, Zerg Crypto, Brenton. Really appreciate you.
Dr. Dave D., what does the Federal Reserve think about cryptocurrencies? I do not know the answer to that question. Do you have any insight into that?
Federal Reserve. I've seen them talk about it somewhat. They don't seem, yeah. There's actually a surprisingly good. It was a paper put out about DeFi by the St. Louis Fed that was like really positive about DeFi. I'll find that paper too. But yeah, if you just Googled St. Louis Fed decentralized finance, you can find their paper. I've seen some other comments. Some seem positive, some seem negative, but they seem like, on the whole, they seem pretty open and in a lot of ways positive about it. Um, we missed one up above. Rocket Pool, Seawalker.
Oh yeah.
Thanks for the question. Rocket Pool has not launched yet, as you know, you've been waiting for it. I've been following it closely and am a big fan of the project from what I've seen. It seems like a really cool decentralized staking pool. Talking back about staking pools. Um, I'll probably use it at least a little bit when it launches. I'm really excited about it. Um,
Is it going to work a lot like Lido, where you purchase the token to do it, or is it going to be more involved, where you're actually sending Ethereum and monitoring a staking node or something like that? Do you know much about it?
there's different ways. So there's some details that are still being ironed out. Well, last I checked, they were still being ironed out. Like they went through an audit, and then they're like, yeah, we need to modify how this works. But so you can come at it from different participants. Like if you just want to provide ETH, you just provide ETH. Or if you want to run a node, but you say I only have 16 ETH, not 32, and I want to use my computer to run a node, then I can come at it from that site as well. And then like all the node users get linked up with ETH providers, and then there's some good incentives, and it seems like a really good way to kind of decentralize pooling, because pooling is a pro and a con thing, because you don't want, like, pooling can lead to centralization, which can be a security problem or a power problem, and but like self staking can be hard. So there's this kind of like pros and cons, and ideally probably you have some pooled and some individually staked or whatever. And Rocket Pool seems like a really good project trying to kind of get the best of both worlds there. So I'm super excited about Rocket Pool. Fed wants to have their own coin and make stable coins irrelevant. They have talked about regulating stable coins, and they have also talked about a Fed coin. I'll be interested to see both. Um, when mining is shut off. Surprised by that comment.
That's a good question, Dr. Dave D. When mining is shut off, what Red is referring to with that statement is when the Ethereum blockchain, which is currently secured by proof of work, which is GPU mining, where people amass hundreds of thousands of GPUs to mine. That's proof of work. And the proof of stake blockchain, which is kind of running in parallel right now. It's called Ethereum 2.0. The two are running in parallel right now. The Ethereum Foundation or developers or leadership team, however you want to refer to it, they will merge the two together and end the proof of work algorithmic requirement for securing the blockchain and substitute in proof of staking. So mining as an activity will not be shut off. Mining as an activity on the Ethereum blockchain will be shut off. There will be other currencies that still leverage proof of work. Bitcoin is probably one of them. Bitcoin mining will still exist. Mining for other lesser known currencies will still exist. But for the Ethereum blockchain, proof of work will be replaced by proof of stake, where you need to take existing Ethereum holdings and put them at stake, right? That's why they use the term staking, to run a validator software that is completely different than proof of work GPU mining.
Yeah. And if you're wanting more kind of like deep details on like how they're gonna execute the merge, the Ethereum Foundation has some really good materials on that. Like I think it's just ethereum.org, has some good materials there, and there's some good discussions with some of the people from the foundation, Justin Drake and Vitalik Buterin, both have spoken about this. There has been some people who have theorized, oh, maybe these ETH miners will like want to keep mining ETH and they'll fork ETH into their own thing, and that would be akin to kind of what happened with Bitcoin and Bitcoin Cash a number of years ago. If they did, they could have their own version of ETH that they'd keep mining. I doubt anyone would use it. All of the users, the DeFi protocols, the users, everyone wants to move to staking and wouldn't follow a mining fork. A fork just meaning it's a separate copy of the blockchain. So
That
that, that
brings to mind the idea of consensus in blockchain projects, right? The miners have sway, right? They do have sway, but so do the other people who are involved in Ethereum in other ways. People who are leveraging decentralized finance, people who are just investors. Those who are interacting with Ethereum in some way have some say, and the leadership team is going to take it this direction. And people can defect if they want and create a copy of the blockchain, like Rhett is talking about. But um, some of the factors that highlight the unlikely scenario where the miners fork Ethereum into a separate currency and are successful in derailing the Ethereum project that we're talking about today are merely adoption and strong voices in the DeFi community highlighting that we want to move in this direction, this proof of staking direction.
Yeah, there's no ETH users, there's no ETH devs, and there's no DeFi protocols that want to maintain mining. And so if the miners fork their own thing, just no one would use it probably. Um, the foundation can change things if they change things to benefit some special interest groups. I thought this was built to prevent that kind of control. Yeah, that's actually a really good question, Dr. David, Dr. Dave D. And I should link. There's some really good discussion that Vitalik has had about that, and there's kind of this balance to be had between having a core dev team that's improving and upgrading Ethereum over time versus completely decentralized governance and control, and maybe a rules-based system, etc. And the way that Vitalik has put it a few times is that people who believe in Bitcoin believe that Bitcoin is 90% complete. And so there are Bitcoin devs and there's debates that happen there and there's changes that get made there. They're smaller changes. Um, and then people have to choose, to adopt those changes or not. Like miners could just choose to not adopt the changes and keep some old thing. And miners with ETH could do that too. And then you just have to see if users use that. And the way that Vitalik put it is that like most people who believe in Ethereum think that Ethereum is 50% done. And so in this period where we're upgrading to ETH 2.0, et cetera, there's a lot more of these decisions being made by the Ethereum Foundation and the core dev team. Um, I think pretty much the whole Ethereum community is on board with that. And they put out these proposals, like EIP 1559 has gotten a lot of interest that's coming in a week or so, and those proposals get put out, and then there's like public voting on those things, and if the community was majorly against one of those proposals in how they're upgrading the Ethereum blockchain, they would not do it. And so there's this kind of nice balance there where there's a lot of direction coming from them, but these proposals are not being made in
in a vacuum,
or like backdoor rooms and like, hey, this is what we sprung on you. The EIP 1559, that's this one that I just referenced, it first got proposed like over a year ago, maybe 2 years ago, and it's been discussed for a long time, and then it was voted on this kind of public proposal.
And it was definitely not without debate.
Yeah.
Right. It does reduce mining payouts. So there was a lot that was a big hurdle for the community to get over. Are we ready for this? Do we want to do this? What's the effect it's going to have on the token or the currency?
Yeah.
And so it was hotly debated. It was just, I think over time, the community kind of came around and decided, yeah, this is the direction we want to go if we want to leave proof of, take a step towards leaving proof of work behind.
Yeah. Yeah. So they can't just change things willy-nilly, Dr. Dave, but they have some influence, and there's development happening and decisions need to be made, but they're made in a public forum in a way that I haven't seen anyone in the Ethereum community feel like they're like some cabal controlling things in like a problematic way that's benefiting one group over the other. I've seen none of that. I've seen non-Ethereum people criticize ETH and claim that it's got centralized control, and I don't think that I personally don't think that there's a lot of merit to that claim. Matterhorn, I too am excited for the future of in-game NFTs. We should have a whole episode about NFTs. But yeah, gaming is one application of NFTs that's already happening, and it's awesome.
I'm actually pretty unfamiliar with that, so looking forward to that episode.
Yeah, what Axie Infinity is one that's getting a lot of traction right now. It's a game, and there's NFTs in there. You can make money. There's all these people in the Philippines that are like, you know, playing Axie Infinity and earning money and selling their NFTs and stuff.
Interesting.
Um,
That's a very
yeah,
unique idea, actually.
yeah. There's some cool stuff there. So yeah, we'll have a whole thing about NFTs and some of you that are less, if anyone that's in the chat that's less crypto familiar might not even know what an NFT is. That's okay. We'll talk about them. We'll define them and there's some cool things there that's happening now and things that will happen in the future, I think. Do you
Awesome.
recommend cold storage by Patty? So this is a way of being a little bit more secure with your funds. So there's different ways of storing it in a wallet. People will sometimes call them hot or cold wallets. And
Hot meaning connected to the internet,
yeah, basically, yeah.
and cold meaning there's a physical disconnect between your wallet and the internet where a bad actor or hacker could somehow access it.
Yeah. So that is a highly secure thing. I don't currently do it personally. I'm not against it. But I do things in DeFi and dealing with that would be hard. If I had $1 billion of Ethereum, I'd probably have some in cold storage or something, but I don't. So, but there are layers of security things you can do. So like a couple of things. There are known copycat sites. Like you pull up a decentralized exchange 1 inch, it might look like it's 1 inch, but it's accidentally has 2 H's and you don't notice it, and they're trying to steal your money. That specific thing has happened to people. So when I navigate to DeFi URLs, I actually go to the official Twitter profile of Uniswap or MakerDAO or whatever, and then I click on their own link to their own page, and then I'll go bookmark those. So that's a good practice. People can have these hardware wallets like Ledger, NanoS, and some of these things made by Ledger and other. Tracer, I think, is one.
Yep.
Anyway, that can add a level of security. It can add a level of annoyance, but the security is helpful. And then what some people will do is like just have a dedicated laptop to say, hey, this laptop, I'm not going to check email with it. I'm only going to navigate to trusted sites, and then I'll have my hot wallet there. But my only internet activity will be this specific internet activity. That's a pretty good security measure.
Yeah, those are good. I took those same steps, right? When Rhett first showed me how to interact with DeFi protocols, we went to Twitter, selected, clicked on the link on the official profile, and I bookmarked those. So I think that's a great step to take.
Yeah, all of those are helpful things. Trust Wallet, yeah, thanks for that. I have a Ledger NanoS that honestly I don't use much, but anyway. There's a real risk there, and this is a new type of like phishing thing where someone could send you a bad email, like a malicious email, and the whole goal could be to get your crypto keys. And so people have lost money that way. So don't click on fishy email links, but also some of these other layers of control can be really helpful.
Yeah.
Yeah. See, asking you to sign into your Coinbase account. Yeah, that's not. It's becoming more of a thing. So you want to be wary of those things and follow some good best practices. I mean, really smart people, like I can't remember who it was, but I think it was a founder of a DeFi protocol, got his MetaMask wallet hacked into and lost his funds. And then one of the things he did was he bought a dedicated computer to do crypto trading on. So yeah, avoid those emails.
That's an interesting idea. I feel like it's
Yeah.
less talked about.
Yeah.
But you're reducing the risk of somebody gaining access to your machine by simply cutting off all the other activities that are unrelated to crypto.
Yeah.
I think that's really smart. I could see myself going that direction for sure in the future.
Yeah, it's not a bad idea.
So we've hit 10:30.
Yeah, appreciate you guys
I think we can call this
joining
episode
us.
a night. Yeah.
Yeah. Really glad to have all the participation. Really appreciate you guys coming in and adding to the conversation. Would love to hear feedback. Are there things that we're trying to demystify that we're failing on? Are there topics you'd like to like to hear covered that we haven't seen here? And yeah, do you disagree with some of the ideas that we're putting out there? Would love to hear that too. So really appreciate you guys.
Yeah, thank you for migrating to the other channel. This is going to be our dedicated CryptoNITE channel going forward. As far as scheduling is concerned, we are planning on going live every Thursday at 8:30 p.m. Mountain Standard Time. I did start up a YouTube account for us. You can find us there. I believe on YouTube we are actually CryptoNITE. Unfortunately, the CryptoNITE username was not available on Twitch, but it was available on YouTube. So here we're CryptoNITE Chat. On YouTube, we're just CryptoNITE.
And we will be uploading these videos to that YouTube channel. So
Yep, exactly. So there can be a history that you can go back and find information that you're looking for. And we're looking forward as well to post other types of written content. We'll probably start, like I said, with Google Sheets or pinned comments in Discord servers. But we'd love to grow the community, grow the conversation. Bring DeFi and cryptocurrency adoption and especially understanding into the mainstream, as it's there's a lot of people out there interacting with it right now, and I feel like it doesn't get the airtime that it merits, simply because it's such an exciting space. So, so thanks again, everybody. That'll wrap up episode 2 for CryptoNITE, and we'll see you all next week. Please tell your friends who are interested in crypto. Again, we'll have a prepared topic, probably 15 minutes to half an hour, and then we'll jump into Q&A. And we'll modify that as we get into more complex topics over time. But that's kind of how we're treating it right now. And please, like Rhett said, give us any feedback. A lot of you know me. You can find me in Discord. You can send me text messages, and look for some visual upgrades as well, where we're not just blurring the unfinished basement.
yeah,
I'm looking forward to putting together a better setup for this. So
yeah,
anything else, Rhett?
we'll work on various aspects to improve this over time, hoping to improve in any way that you guys can give us feedback on. So anyway, yeah, I appreciate you all.
Final plug before we shut it off. When you go to Twitter, you will find, if you search Rhett Ship, you can find Rhett's Twitter account, and I think it's a great way to learn more about DeFi. So thanks again, everybody, and have a wonderful night.